Welcome and good morning. Thank you for joining us today at the Real Estate Financing panel. We've got a great group of folks today, and we're excited to kick your day off with some interesting real estate financing discussion. So I will go ahead and introduce the panelists and let everybody give you a little bit about their background. Will, do you want to go ahead and get started?
Yeah, sure. Hey guys, my name is Will Bowden, founder and CEO of Grasshopper Farms. We focus on outdoor cultivation, and we aspire to produce and provide a premium sun-grown flower, which we're doing right now in Michigan, Colorado, and we have our final inspections in New Jersey this Thursday. So let's go, and happy to be a part of this industry. The other thing I'll say too is that we have aspired to create what I call a decentralized MSO model, meaning that a lot of our decision-making process remains down at the state level to make sure that they're super efficient in what they do as we continue to grow.
I'm Joe Lustberg, the CEO and managing partner of Upwise Capital. Upwise is a full-service debt financing platform for cannabis operators. We work with about 115 lenders, including 50 banks. We do everything from real estate to equipment to working capital, term loans. I'm excited to be here.
Rachel Wright, CPA, Verdant Strategies, and 420 CPA. We've been in the industry for over 11 years. We work on tax, accounting, and strategic advisory for the cannabis industry across the U.S. and expanding internationally.
Yeah, give it up for Rachel. My name is Jason Piazza. I'm the Director of Real Estate at WeCann. We are full-service cannabis advisory, primarily focused on mergers and acquisition and real estate brokerage. We also do licensing and compliance and a host of other services, but I'm really excited to be here and get this started.
Awesome. Well, thank you, everybody. And I'm Samantha Gleit from Feuerstein Kulick. We are a law firm that focuses in the cannabis space. I lead the debt, finance, and restructuring practice, and really glad to be here with you guys. So we're excited to talk real estate this morning. I think all of us have a bit of a different background and taste on why it's so important, but everyone can appreciate that hard assets, especially if you're looking to obtain financing, is obviously really important, right? So depending on what you're going to be using that real property for and how much you might be investing in it, it's important to think about all of the different considerations, from how you select that property to the process and finding a partner to help you finance building it out. And we have a lot of interesting, I think, tidbits on that hopefully would be helpful for folks that are thinking about that as well. So Will, let's start off with you. Tell us a little bit about what you think are the most important considerations for an operator that's thinking about selecting a property, and how that affects the type of use, and what else should people be thinking about when they're just starting to embark on that process?
Yeah, sure. So I think there's kind of a couple things to consider here as an operator. So first, what kind of an operator are you? Because the strategy for cultivation and manufacturing is going to be wildly different than a retail strategy, because location is everything for retail, where it is not necessarily for cultivation and manufacturing. We are cultivation and manufacturing in the different states that we're in, so that was very important to us. Then I think it's really, where are you choosing to operate? Because you're not just choosing to operate there, you're choosing to operate under the regulations of that particular township, county, and state, okay? So you've got to really understand what are the rules of the road where they currently are, because they change daily, weekly, monthly, and how can you evolve with those rules versus fighting them? You got to embrace them. Okay, so what rules are you signing up for as you're doing it? And then maybe you got to start thinking too about, like, what's your strategy as you get the property? So for us, we actually have the benefit of having one of our properties that we built literally from the ground up. We have another property that we took and it needed some major improvements, we might call it. And then we have one property that needed minor improvements. So I've kind of seen the gambit and all the different kinds of properties you can do. All three of them can work, but you better know what you're doing in which one of those scenarios that you're doing in as well. So pick your state, pick your fate kind of thing, you know, and that's the state level, county level, township level, and then really understand what it is that you're trying to build or renovate there, and be locked on to what that plan is and go execute against it.
That's awesome, thanks. So Joe, can you tell us a little bit about some of the do's and don'ts, or what you've seen with respect to the folks that you're working with? Obviously, a lot of people have real property. We've seen a lot of saturation in the market. What's your advice for somebody who's going to obtain financing, and how do they best market their real property assets?
Yeah, like Will said, it really is location, location, location. But, you know, from a lender perspective and underwriting perspective, they're looking at alternative use value, right? And in the event of a default, if they have to foreclose on that property, what other type of business can they put into that facility, right? We see cultivation facilities near city centers getting a high price per square foot, and then you can lend on a higher valuation on that property rather than something that's very rural or in the middle of the desert where the only alternative use value for something like that is cold storage, right? So alternative use value is a very big thing. And then lenders, the most important with real estate is how much is it going to cost you to build it out, right? We see so many operators come in and they're with these insane budgets, you know, $500 a square foot to build out a cultivation facility. And, you know, as you see from all the compressed states and all the available real estate that's available for pennies on the dollar now, you know, that is not the approach in cannabis. It's really sticking to a budget that you guys can handle and being able to execute and raise equity and, you know, building a property that is good for your business to make money.
Thanks, Joe. Rachel, can you tell us a little bit about the folks that you work with and any kind of strategies that people should be considering when they think about valuation of the real property? It's obviously a huge investment when you're going to be embarking on a build-out. What should folks be mindful of, and what can they do to help best prepare themselves from a financial perspective?
Well, I'd say, actually, I think real estate is one of the best strategies in cannabis. It does depend on what you're getting, retail locations. So right now, as we watch like New York, real estate is definitely a hot topic, and it can either make or break you. You've got the DASNY loans that have already crippled a lot of the license holders in New York, as we've seen. And you know, so are you able to acquire some of your buildings, right? And what kind of area are you looking to acquire in? So I've actually seen some of our more successful clients be in more rural areas rather than in the downtown areas. So I think picking your location and not necessarily the most popular metropolitan area can be a good strategy. So at the end of the day, I think what we try to do is poise our clients to be able to acquire real estate, or, you know, I think that's actually one of the best ways to go, because it's a great way to build wealth, and it's a great way you can actually leverage your money. So obviously we've seen some real estate go down. So, you know, Adelanto, California, you know, that's definitely one of the areas. Jason knows that. Yeah, that's a perfect example. So we saw a bunch of people build out a bunch of shells, and it was a huge real estate play, and now, yeah, it's like pennies on the dollar. So you do have to be careful and say, okay, if we're going to build in Adelanto, is there any other infrastructure surrounding that area where we can resell the real estate? Because, you know, to your point, yeah.
The answer is no.
Right. So buy real estate in a sustainable place that you can actually resell it if the cannabis doesn't work out.
Yep.
So that's that.
Nice.
Yeah.
So Jason, I'm sure you have a lot to add. This is starting to feel a little dreary, right? We're talking about how much money people are going to spend, and then there's just nothing else you can do with it in a worst case scenario. Jason, do you have any optimism to add to that, or are you?
I mean, I'm sure I can add some optimism, but you know, I've sourced and negotiated well more than 100 properties for various cannabis operators throughout the country. And yeah, location. It's pounded into your head as a real estate professional. But I think some of the other important ways that people need to measure a piece of real estate, call them legs of a stool, if you will, obviously location, but infrastructure is incredibly important. Even from a lending or investment point of view, if you're going to cultivate, you need to make sure that you've got the right power, that you've got the right clear height. You know, if you're a retailer, you need to make sure that you have good foot traffic and cars per day. The infrastructure is going to change. The cost, as has been laid out, is incredibly important, and that also goes to a little bit with location. What are the taxes that you're going to pay locally and at the state level? But then also in cannabis, I feel that timing is a really important factor to consider. Is it an emerging market? How long is it going to take you to become operational? You know, if you're looking at a piece of vacant land, might you be better served finding an improved property that meets your needs? I would say yes to that. My experience in trying to get clients to source funding for ground-up construction has been incredibly difficult, especially over the last 12 months. But in terms of optimism, you know, the emerging markets, the limited license jurisdictions are really strong. From an M&A perspective, we're seeing a lot more activity over the last 12 months. And real estate is incredibly important in that. I have one client right now who's purchasing retail locations. He doesn't want to see the financials. He wants to know where the property is, and he wants to look at the lease, and that's it. And he'll make his offer based on that. So make sure that you have a good piece of real estate that fits your needs from an infrastructure point of view, and that the location is good, and that your cost is not out of control.
That's really helpful, thanks. So I think a couple folks mentioned what has happened in California, right? And we've seen pricing go up and down. And obviously for somebody who's gonna embark, whether it's self-financed or if you're obtaining outside financing, to build out a property, that's a big investment, right? We've talked about the timing, we've talked about the dollars, there's unforeseen circumstances. So if we were gonna say, all right, we hope to not end up in a situation where the markets become oversaturated or the property values have come depressed, where's the best place to build out now? If you were going to take a property and start from scratch, and I open this up to anyone who wants to share, but where would you, what's the best geographics?
I mean, like Will said, it kind of depends on if you're retail or if you're cultivation, but you know, limited license states near borders where that next state is not approved is a great location. And then you have to think of alternative use value. But when it comes to retail, especially in New York, not many people know that, you know, I also have 4 retail licenses in New York, and we're trying to open in the Hamptons. So we know from a firsthand perspective how valuable a piece of property is and how difficult it is to find. It took us 2.5 years to find the location. We've been leasing it for 16 months, and we're still not open, right? So you have to battle to get that facility open. It's up to the municipality. So like he said, you need to know what is going on in that municipality. When we originally got approved, the town supervisor was pro-cannabis. The next regime came in, and they are not pro-cannabis. So now our job is so much more difficult. So you also have to understand that there's unforeseen circumstances that may come into play, and you have to be able to pivot, and you have to have capital to be able to get through that process, right? If you don't have the money to back it, you're definitely not going to make it through the process. But location is key to success, and thinking about the alternative use value in the event that compression comes and the state price per pound drops drastically like every other state has. You know, you have to prepare for that rainy day.
To answer that question as well, I would say that knowing the amount of different types of licenses that are in the market that you're looking at will really help you decide which direction you're going to go. If you're just a cultivator and there's already a lot of cultivation in that market, might you be better served looking at a different market, or maybe finding a different parallel or you know, part of the vertical integration that you can take part in, whether it's retail or manufacturing or distribution. You really got to know the market, understand where the operators are, understand the demographics, and we have to make those, you know, analyses for our clients when we're looking for real estate or when we're helping them acquire a new business. They really want to know what's the saturation like in each piece of the supply chain.
Yeah, and also like in New York, all these micro licenses are coming online now, and people try to be jack of all trades, right? And so you have, you know, and these are smaller operators, and that's actually very dangerous. So if you're a smaller operator and you're trying to do all things, you can definitely lose your shirt really quickly. So be very careful with that. I'd say if you're a smaller operator, specialize. You should definitely specialize. Not try to be everything to everybody. That's the first way I see people, you know, say that if they acquire the real estate or they already had it, that's the first way to lose it.
I think my colleagues are saying some awesome things here. And, you know, all of these things start with, what is your business plan? Okay? And your business plan includes your identity. So who are you and what are you trying to accomplish? And here's the beautiful thing about this industry. There's not a lot of people out there who have really strong business plans that they can also execute against. Okay, so you have this amazing opportunity right now. And so as you develop your business plan and your identity, what you've got to think about then is okay, so what state am I going to go and try to operate in and execute in? All right, there's your ground rules. And so the first thing you got to look at in that state is, do they have a regulatory framework that is business conducive? They don't all have that, okay? And that's okay. Everybody's trying to figure this out right now. So if you've got a business plan, you know what your identity is, and you choose to operate in a state that you think is a business conducive environment, well, then you get to start going into the property selection then. And there's so many little keys there that you got to think about. And a lot of it just comes back to, again, your business plan and your identity, right? So if you're a cultivator and you're looking at a property that doesn't have three-phase power, you don't have a business plan or identity. That's it. Because you need to know that you got to have three-phase power at that property. I don't care what size of cultivation you are, you better have it there, okay? Also, you got to decide on what scale are you going to launch at and grow to as you consider these different dynamics here. Some of you guys are going to be able to go in and grab a property that you planned on intentionally flipping into something else later. That's a business plan. Some of you are going to be in the industry and be in the industry a long time. That means you're not going anywhere. So you're not going to have a flip the property plan within your identity there too. Those both work. But you got to make sure that you have that plan and you're flexible enough to understand when the dynamics of your market are changing so that you can pivot with it. Look, we're in Michigan and Colorado. Those are the bookend states right now, people. Those are the states right now that are the most volatile and the most mature. Okay? So if you can go into those states and operate under your business plan and pivot with those states and the regulators, including when there's regime changes at the state, county, or local levels, you're on the right track. Okay? But those are the things that you got to consider here. And I think all of this feedback goes back to you got to have a strong business plan and you need to know what your identity is and you got to stick with it and execute against it.
So that's super interesting. So when you think about your business plan and your identity, right? For an operator who's already up and running and has got an established track record, one of the things that I run into a lot is that's an easy one for a lot of investors, right? If you've got an established name brand, you're EBITDA positive, great. We'll be happy to fund you and acquire a good new location because we trust your business plan, we trust your business acumen. What about for newer operators that aren't that far along, right? If you're a newer operator and you're looking for a partner, you need a partner to help finance the acquisition of property. How do you go about that without that track record? And what's the biggest risk if you don't have the ability to purchase and you're forced to end up leasing a property at best, maybe with a purchase option down the road?
Yeah, so I'll kick it off if you guys don't mind. So, because this was our story, okay? Grasshopper Farms was born in Michigan, Paw Paw, Michigan, right outside of Kalamazoo, hour south of Grand Rapids. Our business plan was to bring a higher quality smokable flower to the market. We call it premium sun-grown. Okay? So when we said that that's what we were going to do, what do we got the virtual pat on the back from everybody. Sure you are. Yeah, go do that. Be an outdoor farm that has premium flower. Good for you, buddy. We got all kinds of that because we didn't have a track record yet. Okay? But here's the deal. We had a strong business plan. We already did all of our research. We knew we could do it. Now it wasn't a matter of did we know we could do it. It was a matter of proving it to other people that we knew we could execute. All right? So that first year, when we were growing our first crop, we focused exclusively on premium sun-grown flower. Now, when you're a cultivator, you innately make three things right out of the gate, whether you choose to or not. You're making flower, you're making pre-roll material, and you're making biomass. Whatever you choose to do with those three things, you are making those three things, okay? So we did not focus on pre-roll material. We did not focus on biomass. We focused 100% on that flower. Now, we sold our pre-roll material. We sold pre-rolls, and we sold all of our biomass. But our focus was on executing against what we told the market we were going to do, premium sun-grown flower, okay? And then what happened? We sold out of all three of those things, by the way, okay? And then year two comes around. We sell it again, all three of those things. And we continue to sell it. So now we've started to establish a track record. We move into Colorado, do the same thing. New Jersey, I'm sure we'll be able to execute on the same thing. So I think it came down to we had a business plan that we developed, and it wasn't just an idea. This wasn't like, I like wine, so I bought a vineyard. It wasn't like, I like food, so I bought a restaurant. This was a business plan that was rooted in a lot of research and building a team that could execute against something that we knew we could execute against, okay? That's a business plan. It's not, I like weed. That's not a business
I think
plan.
that's a really great answer. I saw a lot of operators in California not focus on what would happen after they were built out. And it was early, and people had big eyes, and they were just sourcing the funding that they needed to become operational, or perhaps their budget didn't account for the length of time it would take to become operational. But after the baby was born, they weren't ready to be parents yet. They didn't have the budget to be able to actually operate, and that was really difficult in the California market. So it's really important. You have to have a business plan. If you don't have that track record, you need to be able to show a lender or an investor how you're going to source your material, where you're going to sell it, how it's going to be distributed, what your brand is, and really show them that you know after that baby's born, you're going to be able to care for it and teach it to walk and eventually run and graduate high school and give you grandkids.
I was going to say, so Will, I think you could actually lead this whole day with all the great examples that you have, because it's also efficiencies, culture, everything that you're doing is amazing and top-notch, well planned out. I know you've done your market research, right? And so looking at all the different markets, there's people that can actually analyze the different markets, your vertical, and so that analytics going in is totally key, and I'm sure that you did that. I have no doubt. And also, I guess I'd say being flexible to pivot if you have to, keeping a sense on the market and seeing ahead of time, and being able to pivot if you absolutely need to. I think what happens is people get their heads down in their work so much that they don't look out around and see the trends. So kind of a tunnel vision, right? And so don't get the tunnel vision. The reason why we're at conferences like this is so that we can see what everybody's doing, get a sense, put our ear to the ground, really talk to each other, because that tunnel vision can actually kill your business, even as an ancillary service provider, right? So let's always stay alive and ahead of the curve.
Financing in emerging markets is a big part of our business. Construction financing, equipment financing, and real estate are about 60% of what we do at Upwise Capital. We lend to startups all the time. The way that we do that is by securing the property. Our lenders will typically lend 65% loan to cost or 70% loan to value based on the as completed cannabis value of the facility. But like Will said, you need a business plan, you need the ability to execute, you need the team, you have to have cannabis experience. And you have to have skin in the game and liquidity. If you're not going to put your own skin in the game, no lender's going to want to lend you money. But then Sam asked a question about what about the cultivator or the operator that's just leasing the property. If it's a dispensary leasing the property, their only choice is equity. But if it's a cultivator or a manufacturer that's leasing a property, and they own another business. New Jersey is by far our biggest state that we're funding right now, and we're doing a lot of equipment financing. And the way that we do that is by using a cross-corporate guarantor. So any other operating business that the owner owns, whether it's a construction company, a real estate company, an accounting company, whatever type of company, they need to be able to service the debt. So they need to meet a minimum of a 1.25 debt service coverage ratio. They go on the equipment lease as an additional guarantor. The leasee is the operating entity, and then the guarantor is the personal guarantor and the additional guarantor. It's just comfort for the lender to know that while you're installing this equipment and before the equipment is operational and before you crop out, that you're going to move money from one entity to the other entity to make your lease payments, and that that entity's on the line. We do a lot of startups using cross-corporate guarantors. So there are ways to finance it. We also come from traditional financing. So, perfect example is a company here in Illinois, Galaxy Lab. She owned an accounting business. So we could just finance her accounting business. We didn't even have to go the traditional cannabis route because she had another business, so we didn't have to get taxed for the cannabis rates. So there are other ways for us to position. And that's really the benefit of working with us, is that we think outside of the box and we pivot and we figure these things out with you.
So a couple of core points that I think you guys all touched upon, right? There's a couple of key considerations in addition to where is the property and picking the right property and making sure you've got the background and expertise. But we talked about the valuation, right? So I think you heard a couple folks mention alternative use value. I think it's really helpful to just dive in. One of my favorite examples when I was earlier on in the cannabis industry was a company I was working with was trying to pitch one of my investors to support them to buy, real estate or a loan, and they said, well, I've got this great cultivation and it's worth $100 million. And we said, well, that's so great. How did you get that? And they said, well, that's what I spent on it. Or so it was something like that. And so to your point, right, like you're not going to get full credit for the amount of money that you put into this build out. In fact, you're left with much worse alternative use. And that can be pretty scary, especially when you risk unforeseen timing, delays, et cetera. So one of the biggest risks that I see with a lot of the operators we work with is when you're funding that build out, even if you're lucky enough to get that financing, it's a long road, right? Because you have to still cover the costs between when you start on that process to once you're up and running and then becoming profitable. And if you don't already have that established reputation and the other corporate guarantors to lean on or other operating entities, that could be really challenging. So valuation is key. And then I think we also heard some structure points, right? So real estate is so attractive to the lenders because of the alternative use value. It's a hard asset that people can sell to somebody else to do something else with, right? So that's what's going to be attractive to any sort of investor. But how do you think about structuring that? So we talked about a little bit about 280E, right? If you're buying this real property and perhaps you can separate it from the rest of your operating business, people can get really creative with strategies to be more cost efficient and perhaps avoid some of those tax burdens. Rachel, what do you see from that respect? And how important is it to be thinking about that at the outset prior to purchasing that property so that you could be mindful of financial and accounting strategies with that build out process or whatever else you're going to use the property for?
I was hoping we were going to get to this. So, yeah. I mean, so with 280E, obviously there's a lot of ways to navigate 280E. Real estate is one of the biggest ones. So I have a good size operator that just came to me who I may be amending all their tax returns because they didn't really consider this part of it, right? And they're paying multiple millions of dollars more than they should. So think about, I'm not going to give all the tips and tricks away, but obviously we know that real estate is not necessarily subject to 280E. Some people may, argue with me about that, but with some proven audits with real estate companies and making sure you have all the ancillary companies set up around it properly, it can actually save you millions and millions and millions of dollars. So think about that. That's cash in your pocket. So right now, I think I'm going to save this company almost $5 million from amending their tax returns because the accountant did not think about these kinds of things. So that's money in your pocket right away. That's that.
Yeah, it is really great if you can buy your own real estate. But a lot of operators just don't have that opportunity because capital's tight in the industry and you've got to really deploy your capital to be able to build out and become operational. If you can swing buying a property, that is a really huge benefit, but I just know that a lot of cannabis operators aren't in a position where they can do that. If you can find an investor partner whose capital input into the company is buying the building so that you can have a manageable lease payment to them, that's going to be key. I've seen lots of different cycles. I've seen operators buy at a 500% premium, and they're not around anymore because they overpaid, whether it was the lease payment or the acquisition cost in a purchase. That massive premium really hurt them. And to Joe's point, the lenders are looking at the standard fair market value, the non-cannabis value of that real estate. So I've seen premiums go from 50 to 100% as a standard cannabis premium down to 10 and even 20%. There are some properties that might demand a slightly higher premium because of demand and it's freeway visibility for retail or whatever. But yeah, that premium has come down, and it's really, really important that you focus on the cost of the acquisition of the real estate?
Yeah, so we've seen many operators overspend. You know, I was talking to a Las Vegas operator last night who spent like $70 million to build out his facility, and you know, the first lien position foreclosed at $11 million bucks. You know, they'll maybe sell the property for $18 million, right? So knowing your cost and knowing how to build at a good price per square foot is very important. And we've seen it by many lenders who used to be on this stage and no longer on this stage and no longer in this industry. You know, they all lent at the as completed cannabis valuation, and the smart ones lent as on the as-is real estate valuation. There's only one lender left in the space that lends on the as-completed cannabis valuation still. They're really doing it on a loan-to-cost basis. But once you become profitable and you own your real estate and you're willing to move your deposits, you know, we can get you into a bank loan, which is like 9 to 10% over a 10-year AM and a 10-year term with a 25-year amortization. So there are good products available for good operators, right? But you need to execute your business plan, become EBITDA positive, and, you know, if you're somebody like myself, an operator who's leasing the property, you know, you have to strategize your future and make sure that you have a right of first refusal to buy that property at a decent price, you know, not a cannabis exorbitant price. So try and lock that into your lease and, you know, execute on your business plan.
That's great. I think we're unfortunately out of time, but thank you all for sharing your insights with respect to real estate. If anyone has any questions, feel free to catch up with any of us after the panel, and thank you very much.
Thanks, everybody.
Thanks, guys.